Welcome to Around the Track, the most exciting 15 minutes in wealth management by Dynasty Financial Partners and hosted by CEO Cheryl Penny.
Hello, and welcome to another edition of Around the Track, the most exciting 15 minutes in wealth management. I'm your host, Cheryl Penny, founder and CEO of Dynasty Financial Partners, and I'm really excited about this week's episode because I'm joined by one of my partners here at Dynasty, Harris Baltch, who heads up our investment bank, capital strategies, and M&A at Dynasty. Harris, thank you so much for sitting down and having this conversation with me.
Cheryl, thanks for having me. Really appreciate it.
All right, we're going to have to jump right into it because you know there's only one rule on Around the Track, and that is we only have 15 minutes to make our way around a virtual track here together. I'm going to ask you 8 questions. Each one of those 8 questions represents one of the 8 furlongs that makes up a mile around the track.
All right, let's go.
And they're off.
Look, so you know in racing and a lot of things in life, how you start, how you launch matters a lot, how you break from the gate. So I'm going to give you a nice softball question. So let's see how you do.
All right.
Just tell everyone about Harris, personally and professionally.
All right, sure. Well, I'm born and raised in New York. Grew up on Long Island. Went to school in New York, business school in New York, and have a wonderful wife and 2 lovely kids. I worked in investment banking almost all of my career. I started off as a CPA at one of the big 4 firms, and then after business school in upstate New York, I spent about a decade at a large investment bank, primarily doing M&A on the buy side and sell side, but always covering the asset and wealth management space. And was fortunate enough to call upon Dynasty and be invited to build out our M&A and capital strategies team, and now our investment bank.
I remember that call well. I remember we went out for a drink, and I thought you were going to pitch me about your banking capability, and pretty quickly said, maybe you should have a head of M&A in-house, and that led obviously to you coming on board. So I'm very fortunate that you did call me. So transitioning then to what you're doing here at Dynasty, you've been with us for give or take 3 years.
Yeah.
You oversee capital for the firm, both on debt and equity, in terms of how we deploy it to RIAs, overseeing M&A related activity, and then more recently, obviously, we announced the Dynasty Investment Bank. So great portfolio. You have a wonderful team that you're overseeing. What has you, and you're one of the first people in every morning, right? So what has you flying out of bed in the morning and getting to work here at Dynasty?
I mean, there's just a flurry of activity going on. I mean, something that I think you've coined before is, we're entrepreneurs supporting entrepreneurs every day.
Right.
And the beauty of that is, you're excited. Every day is so incredibly dynamic as an entrepreneur. And when you think about our business, what gets me really excited is that we work with clients throughout their entire life cycle. So we work with certain clients that are, at what I'll call the incubation stage, right? They've made the decision that they want to go into the independent space, and we work with them on really constructing what their business is going to look like from a financial point of view in independence. What does that look like in terms of revenue? What does that look like in terms of profit? How are they going to be capitalized? How are they going to structure their organizational documents in order to accommodate certain things around maybe M&A at launch? What does it look like when a partner retires, right? But then after they launch their business and they hit some level of inflection point, we get to think through their M&A strategy,
right,
and how they're going to either tuck in advisors, buy RIAs, buy different types of capabilities. And that's a whole different conversation on helping them think about inorganic growth. And then ultimately, towards the end of the life cycle, they need to think about a liquidity event for themselves. They've taken their life's work from somewhere and brought it into independence, and now they want to be able to preserve their life's work through a monetization event. So it's incredibly dynamic, and we get to work with clients along that entire life cycle.
Yeah, I appreciate that, because that is something that we've been talking more and more at Dynasty is we need to evolve, obviously, as our clients are evolving, and making sure that we have services and capabilities that meet our clients based upon where they are, based upon the life cycle of their business, whether it's launch, the rapid professionalization, or ultimately succession, as you mentioned. So thanks for that. One of the things that you've been in my ear about, for a couple years now, is evolving to the point where we can launch a real and official investment bank dedicated to the RIA space. And I know you spent a bunch of time working with members of my advisory board, with our clients who are also leaning on you to launch the investment bank, and we just recently did. Tell us why you did that, and what makes Dynasty's investment bank targeting the RIA space different.
Yeah, well, first of all, it's been something that we've been working on for a long time at Dynasty, and I think it's a very natural extension of really what we've been doing already. I mean, we have close to 50 clients, $80 billion of AUA across the U.S., and we have clients that are in various stages of growth. So we've built a team, we've been doing it internally, and when you think about what's going on in our industry more broadly, the types of issues that our clients deal with is very emblematic of the types of issues that you see more domestically across the U.S. And I'd also say in terms of studying the space, there's somewhat of a scarcity of really good advice. A lot of different types of firms that were once consultants kind of fell into investment banking. Other firms, just work as a recruiter trying to broker deals, but they really don't work on execution. And so what we found is that our clients who are so hungry to learn about M&A, and we put out a ton of content to educate them, really wanted to, get more exposure to deals. And the best way to get exposure to deals is by externalizing the investment bank, because now we're in traffic on all different types of deals. These could be firms that are independent, they could be backed by private equity, it could be just one advisor looking to sell their sole practice into another firm. And so if we could work with these advisors, the type of information flow that we'll benefit from, that our clients will benefit from, is just invaluable to their overall growth strategy. So it kind of perpetuates itself.
Let's pivot to more of a macro question, the macro environment that we're in. A lot of dislocation in the market, a lot of things going on, obviously, with interest rates, private equity players in and out of the space, strategics in and out of the space. But speaking to advisors out there right now that are really trying to focus on being M&A ready and want to hit that inorganic growth stride, if you will, what advice would you have to them in this environment?
Yeah. Well, I think when you have this type of environment, lots of market volatility, high interest rate, the affordability, requires tremendous amount of discipline. And so when you're thinking about, do I debt finance, do I equity finance, how much do I put down, and what's the profile of the advisor or the RIA that you're trying to go after is really, really important, because if you lack that level of discipline, you're going to see, the affordability mechanic kind of dry up, because that's really expensive right now. And so what we tell our clients to do, Cheryl, and you know this, is, number one, be disciplined, know what you want, and know what you're worth. Because what you're seeing right now is a lot of RIAs use their equity as a form of consideration in order to come up with the deal construct for a firm that they're looking to acquire. And so if you don't know what you're worth and you don't get a valuation initially, it's very difficult to use that as some form of consideration, as opposed to just looking for a 100% debt finance deal or using cash flow from the firm in order to try and tuck in or acquire another RIA.
Yeah.
So it's really important to be ready. It's important to be disciplined, and it's important to know and have a true understanding of what levers of capital you can access in order to effectively close a deal.
Yeah, and I know, to that point on knowing your worth, I know the inquiry that we've seen on requests for valuation work has increased. So I think advisors are becoming more and more aware of it and the importance of it, to your point. I want to drill down with my next question, though, a little bit further on something you just said, which is around the cost of capital. In particular, interest rates obviously have moved up significantly in a short period of time, and perhaps that's changing advisors' views on how they should use debt versus equity to fund M&A. Do you have a point of view based upon where we are in the market cycle right now?
Yeah, I think because debt is expensive, and a lot of firms or advisors that are looking to either get sold or tuck in, or looking for some type of capital event at closing, you really want to right size that capital event with the expectations of what that transition is going to look like over time. So it's really important to, underwrite a deal where you're able to make sure that you're effectively de-risking yourself as the revenues get replicated onto your firm. Mm-hmm. So if you're going to use debt capital, I think it's relatively important to make sure that you're structuring an earnout that makes sense and you're not over-risking your balance sheet in order to either acquire or acqui-hire or buy an RIA. And then really it's the same thing with equity. I mean, even though historically equity is always more expensive than debt, you don't want to just give it away. So you want to have very special provisions, clawbacks, and earnouts related to equity in order to make sure that if an advisor or a team or an RIA hits their milestone, then they're awarded the equity as opposed to just giving it all away up front. And if the advisor or the RIA who owns your equity decides to walk away for some reason, that you keep it in the system so you don't offer dilution to the advisors that are at the firm that are trying to continue to grow value.
Look, it certainly seems like we've been in this growing bull market around M&A in the advisor space. Everyone understands the value of a financial advisor, the stickiness of revenue. There's a lot of reasons to really like the space. But with a lot of that competition, obviously some of the multiples have gone up. The valuations have gone up. The number of deals, I know even more recently, for the first time in quite some time, has actually pulled back the number of transactions. But a lot of these businesses, to your last point, have funded the M&A with debt. And we've seen some of the headlines with some of the large private equity roll-ups out there that have had to raise capital with some pretty aggressive terms, it seems, to deal with some of those debt-related issues. For someone who's maybe further down that path and they already have a higher debt load, how should they be thinking about dealing with that in this environment? And for someone, the flip side of that, so if I can get maybe two questions in one, if I don't yet have a lot of debt, presumably I'm in a very advantageous position. Mm-hmm. How can I go on offense and take advantage of that?
Well, I mean, if you have debt, you could certainly think about merging your business with another firm that has less debt, so that the combined mm-hmm. Power of two firms will help accelerate growth and accelerate the pay down of debt. Or you could just focus on what you can focus on, which is growing organically, right? Blocking and tackling is through organic growth is the best way to address a debt burden. Trying to cut out costs is really just a one-time event. And so if you're looking to, improve profitability, perhaps for a reason to pay down debt, just cutting costs is something that, will be episodic in maybe 1 year or two, but it doesn't address kind of the long-term issue. What was your second question?
If you have less debt, right, obviously this is an incredibly opportunistic time. How do you go, on aggressive offense?
Well, I think you're in a position of strength. If you don't have debt, you can be incredibly selective with the types of firms or the advisors that you are going after. And given that the debt market has matured in that a lot of traditional providers out there, including ourselves, are just very comfortable underwriting M&A. You could be very selective with approaching it with a strong strategy that involves a combination of debt and probably equity.
Yeah, okay. So we're turning for home. Just two questions left.
Yeah.
Let me just pull us a bit out of the weeds, if you will, because I think this conversation has been great. A lot of it, I think, will resonate with those that are in the middle of M&A or who have more expertise. But let me ask you a higher level question, which is, what if I'm out there and I'm listening to this interview and I want to become M&A ready? Mm-hmm. I want to do M&A. I'm not sure how to get started. Right? I understand the importance of it, but I don't want to make a lot of mistakes, right? I want to benefit from mistakes of others or in that collective learning. What advice would you have to an RIA principal who says, my growth organically is great. I now want to get into an inorganic growth mode. How do I get started?
Well, you want to call up an investment banker and you want to learn about the space.
Right.
there's just it's a vibrant market out there right now, Cheryl, and it's important to understand who the key players are, both on the buy side, who are the key capital providers, how do different business models differentiate from each other, and it's important to know what your discipline is, right? In educating yourself about the market, you can also make a determination of how you want to participate in it. The other thing is, and I forget who's told me this before, maybe it was you, is that it's always good to risk a thumb or a pointer finger before you risk a foot or a leg, right? And so what I mean by that is, if you are new at M&A, going after an opportunity that is, much lower risk, where you won't bet the farm, is going to be much more, potentially accretive, and you'll learn a lot more and risk a lot less than going after like a large acquisition. The other thing is, go out and get a valuation. It's really important to know how a third party perceives your business and what the going concern value could be of your business, because that'll give you a really good understanding of how a third party views your firm and values your equity. And then, to the extent you use that as currency in M&A, will make you that much more M&A ready.
Awesome. All right, last question. It's the same last question I ask every guest on the show, which is, what is your Triple Crown moment? What is that, one big, seemingly unattainable goal that's out there?
Yeah.
And what I love about this show is it allows me to play off my passion and love for the thoroughbreds and for racing with wealth management. And whether you're an owner like myself with thoroughbreds, a trainer, the jockey, the grooms, the whole team, it feels like it's always out there, but it's never quite attainable. But you're going to continue to work hard towards it. So if you think about that, whether it's in a personal or professional context, what does that look like for you, Harris?
Yeah. Every time we work on an M&A deal, Cheryl, there are three primary stakeholders, right? It's the owners, it's the employees, and it's the end clients. And we want to make sure, when we're working on a transaction, that every deal that we do appeases those three stakeholders. And so whether it's 12 months from now or over the next week, we want to make sure that when we're engaged on a transaction, that we're just focused on those three stakeholders. Because if you can get that right in any transaction, you're going to be checking the box on culture, you're going to check the box on valuation, and you're going to check the box on continuity. And really, at the heart of a lot of these M&A transactions that you see in the RIA space, folks are just looking to perpetuate their clients' experience or increase their clients' experience by partnering with another firm. And that's what we try to do every day.
Look, partnership and sustained excellence, winning consistently over time, those are all attributes, obviously, of a dynasty. So really enjoyed this. Thank you for joining me in this conversation, Harris. I appreciate you as a partner and as a leader on all the initiatives that you do here at Dynasty.
Thanks, Cheryl. Thanks for having me.
And thank you to all of you tuning in for this conversation as well on another edition of Around the Track.